Hello, Jim here. Last week, the markets ended in a kind of a rough way. I don't know what next week's going to bring. We have a lot more earnings, so it could be a continuation. Are we in a market correction? We may just be in a market correction. Some companies are definitely down at least 10%, others not so much. I even have some companies that are up currently, like Coca-Cola hit an all-time high this past week, I believe, on Friday. And same thing with Procter and Gamble. I think Procter and Gamble is really close to a 52-week high. So today I want to talk about how to manage your stocks and your securities during one of these market corrections. There's some key things you can do, some strategies that can really help. I'm going to share with you the strategies I use and what my plans are for this week. I'm going to probably go over one or two stocks that are deep in the money and how I'm going to handle them. So stay until the end where I actually will go into details. So let's go ahead and get started. Now, what I've done is I've come up with some key strategies. I first want to talk about, assessing the market conditions. Are we going to continue in a downward spiral, or is this just a bounce? Some key things to look at are technical analysis. What's going on in the markets? What's going on with the Fed, with the government? Kind of take a gander at those things. I think definitely with the labor report on Friday, I believe the economy is a lot weaker than what the government's reporting. And I believe we're probably in a recession. I don't know if it's a hardcore recession. Hopefully it's just a light recession that we will come out of pretty quickly. But I do believe they've been underreporting the unemployment numbers and probably over-reporting how good or how healthy the economy really is. So look at those technical analysis. Look at what the analysts are saying, not so much on CNBC or some of these core media outlets, but look at like Morgan Stanley analyst or look on Seeking Alpha. There's a lot of articles out there. You can also look at Yahoo Finance. The other thing to look at is the VIX. Is the VIX increasing? I share here that you can monitor to the VIX to understand market sentiment and anticipated volatility. If the VIX is above 20, I pulled this off of ChatGPT, but typically it's associated with market stress or panic. Suggests that traders anticipate significant volatility in the market. A moderate is 15 to 20, reflects moderate volatility expectations. Traders might use this period to adjust their strategies based on market sentiment and positioning. And then finally, low VIX, which is below 15. And this is actually of the last 20 days. So you can see the VIX has been going up. It's not in that 20 level, but it's definitely in the high 17s, getting pretty close to 20. I believe it got about 17.6 or 17.7. So the VIX is an indicator that volatility is going up. There's a bit of fear. Also, when you have a correction, a lot of things will occur in the markets. You'll get margin calls. People may have taken too much risk and then may get a margin call, and that margin call may force them to potentially maybe do some assignments that they might not have had to do before, and suddenly it becomes a domino effect. Margin calls will impact, will cause other margin calls, and it'll continue, and you'll see more and more. So a lot of times the momentum will pick up on a downward side, and it goes pretty much with VIX. As VIX goes higher, it kind of reflects that panic, that momentum downward, the point that people are trying to save their accounts or get out of positions that, where they have to sell some stocks, they get out of some bad positions. I like to use my trading journal. I'm going to share with you my trading journal. I share this with my members. I actually released one this morning that talks about pretty much any of the positions expiring soon and which ones I need to manage, which ones I'm less worried about. And then it also talks about in a part of the journal, how I plan to kind of address these. So, and it's also a great way to kind of track your trades, look back, determine, what level you got in, I like to put the delta in there. I like to put the strike price. It's just a good way to kind of keep track of where you are. and then reevaluating underlying securities. I like to talk about this a lot, but I'm a fundamental analysis person. I'm an investor first, then an options trader. To me, option trading is more extra icing on the cake. It's not the core way I trade. Now, that doesn't mean all the people in my memberships, that's how they trade. Some people are just purely traders and they don't really care to invest. I like to invest. I like to find companies I can invest in and pick up at cheap prices. Back in 22, one of my biggest mistakes was rolling out of the opportunity of owning some great companies cheap. And I don't want to do that here. I have some companies, again, that I'll talk about at the end of the video. A couple examples are Dell, Airbnb, AMD, a few companies like that I could potentially pick up at really good prices. Even NVIDIA, if NVIDIA continues to go down, there's a point where, in my mind, it looks really good. And then also industry trends. When I look at companies, especially when there's a bit of a correction, I will go and I'll look at the graph farther out and try to get a feel for where they are long term. Are they still way overpriced or overbought? And it just kind of gives me a feel, how does it compare to the 50-day average, the 100-day average, the 200-day average? What's the PE? What are some of those core values? And has anything changed with the company? Has the company had a bad earnings report and things don't look so up for it anymore? My goal is to own these companies long term. A $50 company today in 5 years could be a $100 company or a $150 company. So looking at their long-term viability, what are they going to become? It's kind of like looking back at Apple 20 years ago, when they got a cash infusion from Microsoft so that they wouldn't go out of business. I think Microsoft paid them a couple $100 million also to keep the DOJ, out of their hair, because if Apple had disappeared, Microsoft would have been a pure monopoly and it would have probably been broken up. And then also diversify your portfolio. I've noticed lots of other YouTubers, are talking huge contracts, many contracts in NVIDIA or, specific companies. I try to diversify. You'll notice, especially in my membership, I deal with lots of different companies, and I even deal with a lot of ETFs. I will trade SCHD, I will trade IJH, IJR, which are both mid-cap quality value companies. I'll also look at XLE, which is a really good energy ETF by iShares. So I will diversify a fair amount. Now, one thing you can do when the market is really crashing and things are going down is ETFs don't typically move as much. So maybe do more trades in ETFs versus potentially stocks that may, at some point if the market really crashes, it'll turn the tide for all companies. So all companies will go down, kind of like in 2020 or any of the previous corrections, everything went down at some point. So I'm thinking we're more like a 10% correction, which we may be halfway there. We may get a similar week as last week, and that may be the bottom, especially with the fact that the Fed is talking about a 0.5% interest rate cut in September and potentially over 1% before the end of the year. The betting odds, that's gone up significantly. I think it's like a 40 or 50% chance that it'll be a 0.5% cut in September, which is pretty significant. Once that gets entwined in the market, I wouldn't be surprised that the market gets a bounce. And then you can manage your cash secured puts. If you have cash secured puts, you can, one thing you can do is maybe lower your, how much conserved capital you might be using for them by switching them from a vertical put credit spread or from a cash secured put to a vertical put credit spread. So you could buy or you could purchase the put to protect you on the downside. And I've done that. I did that with Tesla, and I've done that with a few other companies. Now, currently, I'm doing all vertical put credit spreads. You can also do stop loss orders. If you're willing, you want to get out of a particular position, then identify what's the biggest loss you might want to take. But I do want to insist on patience. A lot of times I found my positions will recover. I have a rule that I call it my 10% rule. 10%, if it's more than 10% in the money for a put. So I give you a for instance, say you have a $100 stock and it's currently $90. Well, that's 10% in the money. At that $90, it's at risk of being assigned to you. So you definitely need to manage it. You need to take these kinds of steps that we're talking about. But again, go back and look at why you originally purchased it. Allowing not assessment, assignment, it may be your best bet. It may be what you need to do because it's a great company and you're potentially picking it up at a great price. So, again, adjust the cash secured puts. You can also, potentially roll out and down. You might even be able to widen the spread. So say you have a $10 spread, so you sold a 90 and bought an 80, well, you could potentially roll it out and then sell an 85 and buy an 80. It's a little bit more of a spread, but you could potentially still make some premium and lower that overall price or that short, meaning if the stock's assigned to you, it's $85, or it would be assigned to you at $85, which is a lot less than 90. Now, what you don't want to do is dig a deeper hole and get yourself into trouble. But I do that pretty consistently. I've actually, widened the spread by 15 and then gone the other way and thinned it out by, putting it back to a $10 spread at one time. I believe I did that. I can't remember with what company. It might have been Dell. And then covered calls, I do encourage people to do covered calls as well as, cash secured puts and vertical put credit spreads. So when you have a market downturn, a lot of your covered calls will become profitable. You can roll them down or you could potentially close them so you can reopen them when the market does recover and start moving back up. I found that's what happens with me. It's been weird this last couple of days in the markets because Coca-Cola hit an all-time high. So I'm having to manage those calls by rolling them up and up higher and higher, out and higher, that is. But, again, if we get into a full-blown correction and it's anything more than 10%, then again, it's going to sink all boats. Even Coca-Cola would probably go down. And I know with Coca-Cola, even my leaps, if it drops $5, suddenly all my leaps have become very profitable. If it drops below $60, it would be even more so. So also selling covered calls, and you can move your covered calls down. So say the stock drops by $10, you could potentially lower your strike price for your calls on the same expiration and pick up even more cash. And I've done that a number of times, not just with Coca-Cola, but I believe I've done it with Procter & Gamble. I think I did it with Con Edison. So it definitely is a pretty good strategy. You end up moving, as the stock moves, you move the covered calls up and down. So, and then with iron condors, if you're doing iron condors, typically you're hopefully doing them like what I like to do, which is what I call a 10 delta. And I usually take more risk on the call side. So usually you can also roll them. You can move the wings down so you are taking on less risk. So, and the fact that you can move both sides of the wings, you can bring in a fair amount of premium by moving the iron condor around. And that's what I've done before. So, I think I did it with Cisco where I think I ended up closing the call spread, and then I just rolled the put spread down, and I believe I still have it. I might have even changed it into a cash secured put because I think Cisco's at a great price, and it pays almost 3.5 or a little more than 3.5% in dividends. So definitely something you could do, and you can also exit early. If you brought in a lot of premium, you may still have a 40-50% profit and can get out of it pretty safely. So that's what I initially wanted to talk about. In the next part of this video, I'm going to actually share with you, we'll look at one or two companies that are currently in my portfolio that are deep in the money and how I'm actually going to be looking at them and trying to decide what I want to do. So stay tuned. Let's jump into that. Okay, this is my weekly planning worksheet. I keep track of trades that are in trouble. Like here, you can see the darker yellow for status are the ones that are currently fairly deep in the money that I do need to manage them. The orange status here is primarily related to ones that aren't as deep in the money, and I can probably roll them and manage them pretty easily. And then I've got this currently sorted by expiration, but I can also sort it by symbol. I can sort it by trade date. So I end up using this quite a bit. I also keep it up to date. My favorites, the companies I like the most, I have a tab for that. I have a piece that I'm currently working on, trade rankings. How do I want to rank these? I think at some point I'll flesh this out even more to help me to pick better companies and ensure that I'm picking the best companies. I have checklists, guidelines, goals. So everything is right here. Once you're a member at any level, you get access to this. You also, at the investor club level, get all the spreadsheets. You get my status reports. Every time I make a trade, I literally post it to the community right after I make it. So, no delay. And you get that at all levels. I have a higher level that's called the trader club level. With that, you also get Discord. You can see what other people are doing, what kind of trades other people are making. I also have sections about 0 DTE types of trades, futures trades. I'm currently not doing either one of those types of trades, but it's something I like to look at. I like to follow what they're doing. So at some point, if I want to do it and I have the time to do it, then I probably will. And then I have a coaching level that includes pretty much everything at the other two levels, but I also provide 2 15-minute sessions every month where you get to talk with me directly. Now, with any of these, you can have access to me fairly easily. You can do DMs to me in the Investor Club, in Patreon, and you can also send direct messages to me through Discord. And I typically answer them pretty quickly, unless, I'm in the middle of playing tennis or have a client call or something like this. So, well, let's jump into this. So the two I'm going to talk about are UPS and Airbnb. So UPS is currently, I believe it's not quite at that 10% point. I like to say it's not quite 10% in the money. So if it was 10% in the money, that would be $13.50. So you would subtract from the 135. So it would be like 120, 122. But I believe it's pretty close to 126. So I definitely want to manage that. Same thing with Airbnb. I do think this one is pretty close to that 10% in the money. I did a 140, 130, and all these are expiring on August 16th. So this one, both of these, I do need to manage. So what's critical for me is determine, do I still want to own these? And right off the bat, I do know I like both of these, but I like to go back in and see if there's anything new. So let's first look at Airbnb, and it's currently at 128. I believe what was my rate? Airbnb was 140. So yeah, it's right there, pretty close to that 10% in the money. You can see the dive it had on Friday. It dove almost 5%. So earnings per share is nice, $4.54. It's got a fairly low PE. It doesn't pay a dividend. I like it mainly because I like using Airbnb. I like to purchase companies that I use, I enjoy. And when we go on vacation, a lot of times we'll rent at Airbnb. Their earnings are kind of sporadic, but they've been definitely trending up. But the year-over-year earnings are kind of odd looking, so you can't really gauge as much with it. They do have earnings coming up next week, 8/6, so that need to keep that in mind. Growth, they have pretty good growth. So revenue growth looks like it's nearly 18%, between 14 and 18. Forward looking is 14. The earnings is a little bit down, depending on year over year, but overall their growth looks fairly good. Profitability is also very good. They have return on common equity 74. You don't see that very often, one that high. And then they've got return on assets, which I also like to look at because it means they're using their assets wisely. So that's good. Momentum, it's just kind of mixed. So 128, and it's expiring on 8/16. So, and I think I earned about $1.50 when I sold this. So I would be right around 138, I guess. So I do have a put where I own the put at 130. So I could also come over here and look at options, and I could look at the August 18th. I don't want to look at calls. Might be a little easier to look at it this way. So I can look at the 130 for the put. So it'll be worth a lot, almost 765 if the market stays where it currently is. So by selling the put, I could potentially bring in another $7.60. So if I come back, that means it would be 140 minus 760, so 133, and I brought in $1.50, I think around $1.50 before, so I'm really close to the 130. So not bad. A little bit higher than this. So would it be an all-time low? No, not necessarily, but it's when you look at it this way, you can see how crazy high it was back in 21 and then 22. It's right in that same range. I almost discount 21 because the values were through the roof. They really didn't make any sense. The other thing I can look at, what does it look like if I wanted to sell a call at that same price? So say I pick it up, my cost basis is 130. I could sell a call, and again, it was way down, so these numbers would be lower than what they would typically be. So I could sell a call, and I might go a little farther out. Let's look at September 20th and look at like a 140 call, and I could bring in almost $5. So long story short, the premium looks really good with Airbnb. I think long term I can do pretty well. The last question I might ask, could it drop down to 120? But I think I could still do pretty well, even if it drops down to 120. I also like to see if there are any articles, and it doesn't look like anything that new today. The opportunity. So this article is a buy rating opportunity of Airbnb Q2 earnings. Buy this stock while it's cooling down, and then I also like to look at the comments. There aren't many comments here. You can also usually get the details about the earnings. So being that the earnings are coming up August 6th, it would be something good to look at. So that brings me back. Yes, I could get out of Airbnb, and I could take a loss and close it, and maybe take $400 or $500 loss, but that would be a mistake. I really want to own them. I want to be able to sell covered calls on them. So right now, I'm going to do whatever I need to do to either allow them to be assigned, or if I roll them, I want to be able to pick up enough income that it makes it worth my while, because again, I could start selling covered calls on them pretty quickly. So nothing's changed. I might change this color to a different color if I wanted to potentially get out of it. So now let's look at UPS. So they're 135, 125. Let's go back into Seeking Alpha. And you can see how much it dropped. They had missed earnings, so I believe they've had earnings recently. So 128 is near their 52-week low. So will it go down much more? It could. I'm not so sure it will. Since mine was 135, 125, I believe is what it was. So it's not huge deep in the money. Now, they do pay a really nice dividend rate, so $6.52 on a yearly basis, which is over 5%. And then with selling covered calls, that could be really profitable. Now, what do their earnings look like? Now, they did miss earnings last week or 2 weeks ago, but the rest of the year, it looks like they're really going to kind of bounce back pretty nicely first and second quarter of next year. And I do know that labor was more expensive, but their volume was up. So, and they're doing some things to deal with the labor issues. Part of it is related to the union contract and the agreement that they made, but I think they're going to figure that out. Growth, not very good growth, so that's not really good. Dividends, I like so they have really good ratings for dividends. They are paying out a lot, but for a big company like them, Coke, I think, pays about the same amount, 89% payout ratio. So the 5%. So it's fairly safe, 5-year growth rate. So they're still growing it pretty nicely. And they've been growing the dividend 14 years. So that's pretty nice to earn that kind of a return, 5.09%. And if you doubled the dividend, you're bringing in close to 10%. So I do like that profitability. Let's see how they look. Profitability, return on common equity, 28%. I like that. I like as close to 30% as possible. Return on total assets is a little bit low. I'd rather it be in the teens. I'd rather it be like 13. So that aspect's a little bit low. But overall, they do have some great cash from operations, which is really good. So they've got some pretty good profitability. Now options, let's look at how they are. So let's go out to August 16th. Let's go back. So the put that I could potentially sell if I have to is at 125. So let's go back and see what the value is at 125 for the put. So here's 125 for the put. So I could bring in $1.39. So I could potentially reduce the 135 to like 130. I think I got originally $2. So my cost basis would probably be pretty close to 132. So what I like to do next is look at what would selling a covered call look like with them. So let's go to September 20th. Let's look. I wouldn't want to sell it right at my cost basis. I'd probably go to 140, and it's about 80 cents. So not bad, not great either. If I did 135, it would be 179. So I would have a bit of a profit, but a lot of times I'll go a little farther out because September 20th is only like 48 days now. So if I went out to October 18th, and of course they were down big time, so these numbers would be a bit higher. So if I looked at 140 again, you're talking $1.56. So my guess is that would be pretty close. So if you did $1.56 divided by 140, and then this would probably be times 4, I believe. So actually it would be probably times 5, not 4. So I could get pretty close to a 5% return. And again, with this down, these numbers would probably be a bit higher at probably be closer to $2. So I could definitely double the dividend. So I like UPS. So also I might also come down here, see what people are saying. There's 15 comments. This was just a couple days ago, so we could look here, see what they're saying. I like to come down and look at the comments. I would also read the whole article and then come down and read the comments, but I don't want to keep you guys on here forever. So, yeah, they do all their returns at the UPS store. Yeah, and people, they like it. They want to own it. So raising the dividend. So they did raise the dividend. So they may do smaller raises going forward. But I'd read through that, see if there's anything, that potentially I don't like. And then I would come back. So I could pick them up around 131, 132. I can sell pretty good cash secured puts on them. I can pay us a 5% dividend. It looks like I could probably double that dividend fairly easily. So make 10% on them just with dividends and cash secured puts. And they don't move a huge amount. So for both of these, that's kind of the strategy I would look at, one to determine, what can I do with them? And then, looking at like with Airbnb, there was a lot of value in the put that you could sell. Now, again, it's deeper in the money, and that's part of the reason. I could even widen this spread and, do a 135, 120, and probably could pick up some premium and lower it if I wanted to. So that's probably the big decision I would need to make. I'd have to plug that into my trader page, either in Schwab or Fidelity, and see what it looks like. And if I can get a fairly good return, like say over 20 or 30%, or maybe even over 40 or 50%, then it's probably worth rolling, to 135, 120, and maybe go out another month. And then at that point, so that's one thing I would look at. The other one is letting it get a sign and then start selling calls, sell that put to bring in, another $100, $150 per contract. So that's typically how I look at it. And again, you can see I don't throw a lot of weight behind one particular company. I've got pretty much everything here. I've got GigaCloud, UPS, Airbnb, ACLS, AppLovin application, which is a really good company too. This is Broadcom, another great company. CF Industries, they went up when everyone else was going down. So I think they're $2 or $3 out of the money. Chewy, so I don't throw a ton of contracts at any particular company. If I do, it's because they're inexpensive. Like Chewy, I have a small spread, 22.50 and 20, and same thing with Marathon Digital, I think is what they're called, and that's a $17, $13 spread. So in those cases, I take a little bit more risk, but you don't see me doing 10, 20, 30 contracts. I think that's a little bit crazy. So let me know what you guys think. Let me know if you do something along these lines too. How do you manage these trades? If we get another day or two like we did Thursday and Friday, all of these could be fairly deep in the money, and it would be a similar situation for each of these. I also keep a lot of cash in my account. I believe I have over 250,000 in just in my Fidelity account. So I have plenty of cash to have all of these assigned. It wouldn't be a big deal. So the only one I'm probably questionable is Mara, and it's just because I don't understand Bitcoin mining. This was kind of a learning prospect, and their earnings did not look good. So as always, again, leave a comment. I try to get to all my comments within 24 to 48 hours. Like I said, I'd be curious to hear what you guys say. And as always, thanks for taking your time to watch, and look forward to seeing you next time.